In this video, we're going to review the accounting that managers should know related to plant, property, equipment, and intangible assets. When a company purchases plants, buildings, property, land, and equipment, what happens to the balance sheet and the income statement? Well, the long-term asset account, PP&E, plant, property, and equipment, is going to increase. Again, remember, this is a long-term asset. And what else? Well, either cash will decrease in the unlikely event that the company buys an entire building for cash, or more likely, a liability will increase. And companies will typically match the financing, for example, the length of the loan for building, land, or equipment to the expected time of use for that land, building, or equipment. As one thing I want to note first is that the buildings and the equipment lose value over time, or wear out over time. But we assume that land does not wear out over time. So land will never be depreciated. As buildings and equipment are used in operations, the cost of the building and equipment, my mistake here, is allocated to the period in which it will be used, and usually evenly over time. This is called depreciation expense. And when depreciation expense is recorded, the related asset, plant, property, and equipment, they're usually lumped together in one line, is reduced, not directly. The same way that we saw that accounts receivable are not reduced directly, a special tracking account called allowance for doubtful accounts was used. We are going to create a new tracking account that's going to be for all of the depreciation related to PP&E. So PP&E is reduced using a special tracking account. Tracking account called accumulated depreciation. Accumulate, to build up, depreciation. Let's build up or keep adding together all of the depreciation that has been recorded on the asset. And then the balance sheet will show both a line for plant, property, and equipment, and next to that, it will show less the amount of accumulated depreciation. And we call the difference between the plant, property, and equipment and that accumulated depreciation the net book value of that PP&E. All right, let's look at some quick examples. So depreciation is the allocation of an asset's cost across its life. So if I bought a car on January 1st, 2017 for 30 grand, expect to use it for 10 years and then donate it for no cost. What does it cost me per year? Clearly it's the $30,000 divided by 10 years, or $3,000 depreciation expense per year. That's the easy part. Now, accumulated depreciation is the total amount of depreciation expense recorded on that asset life to date. So after 1 year, how much will be reported in accumulated depreciation? $3,000, and then after 2 years, it's going to include the $3,000 for year 1 plus an additional $3,000 in year 2, so a total of $6,000. And what would the balance sheet report? It would report PP&E of $30,000 less the accumulated depreciation. This is due for 12/31/2018 of $6,000, and it would show a net book value of $24,000. So we give the investors the entire story. This is what we purchased it for. This is the amount of that asset we've used up in operations, and this is the remaining value. All right, let's move on to intangible assets. Oh, actually, yeah, let's move on to intangible assets. We are going to get to some measures of profitability and efficiency of long-term assets, but we're going to do that using total assets, return on assets and assets turnover. So before we don't have any ratios specifically for plant, property, and equipment, so now we're going to go to the next other major long-term asset, intangible assets. Intangible assets, they have value to the company. Why do they have value? Because they're going to help the company produce future revenue and or income, but they have no physical substance. Examples, well, we're going to split the examples into two types. One is the legal rights, patents, trademarks, franchises, and copyrights. So the company pays cash in order to acquire these legal rights, and the amount that's paid, the cost of these legal rights, is valued on the balance sheet as an asset. A second type of intangible asset is called goodwill, and this is not a legal right. Goodwill is the difference between the amount paid to purchase a company so goodwill will only arise when one company purchases another. And the fair market value, the assumed fair price of the acquired companies assets less liabilities. So when one company is looking at analyzing another company, considering purchasing that acquired company, how much should it pay? Well, it's going to receive all of its assets, but it also receives all the liabilities, so we're going to reduce the assets by the liabilities that the acquiring company has consumed. And that difference we typically call the net assets. Why would a company pay more for that? Well, there's something about putting together all of those assets for that acquired company that makes it more valuable than just its individual net assets. So we say that if we're paying more, we call that goodwill. Let's take a look at an example. Parent company purchases subsidiary company for $1.6 million. Subsidiary company has the following balance sheet. Current assets, so we're assuming cash, accounts receivable, inventory of $700,000. Long-term assets, plant, property, and equipment of $800,000, so total assets of $1.5 million. But it also takes on liabilities of $200,000, so the benefit of $1.5 million is reduced by liabilities of $200,000. So we would say the net assets of this company are $1.3 million, but parent company pays $1.6 million. Why did it pay $300,000 above what it's consumed by purchasing this company? Well, it just thinks it's worth that much. This difference of $300,000, so the $1.6 million cash payment, less the net assets of $1.3 million, this $300,000 would be recorded as goodwill to the acquiring company and reported as an asset. So here we have the fair market value of the assets less its liabilities. The amount paid above is $300,000. That's recorded as goodwill on the balance sheet. Let's look at a couple true and false questions related to these long-term assets. When a company buys a building, the company records an expense on the income statement. Is that true or false? Clearly that is false. There's no expense until the company uses the building in operations. When a company uses a building over the course of a year, the company records an expense on the income statement related to the use of that building. That is true. That's depreciation expense. Finally, when a company reports depreciation expense, cash also decreases. True or false? That is false. Assets decrease using the special tracking account, accumulated depreciation, which reduces the value of plant, property, and equipment. All right, now that we've gone over all of our assets, accounts receivable, inventory, long-term assets, plant, property, and equipment, and intangible assets, we can assess the profitability of the company's assets using the following two measures here. Return on assets. What are assets used to do? They are used to generate sales, and more generally, those sales come with expenses, so more generally, generate income. So return on assets, net income divided by average total assets. Of course, higher is better. Asset turnover looks at the relationship between average total assets and sales. How much sales has those assets produced for the company? And again, higher is better. Then we have three measures of profitability. That we're going to look at. Earnings per share, we looked at last class. We take the company's net income for the period, subtract out preferred dividends because we're taking the common stockholders' standpoint, and divided by the weighted average number of common shares outstanding. Another measure of profitability is the gross profit rate. This looks at the company's, taking the income statement perspective, gross profit was what percentage of sales? Remember what gross profit is: your sales revenue minus cost of goods sold. And finally, the profit margin rate. So we know gross profit is not the end of the story. From the gross profit, we subtract out operating expenses. We also subtract out interest expense and income tax expense. So what's left over for the stockholders is net income. Let's look at net income as a percentage of sales. And of course, for all of these measures, higher is better. That's it for this video. In our next video, we will work through the ratio analysis for Walmart.